Tell me, Aaron, what is meant by making a contribution into superannuation?
Making contributions into your fund means getting money or assets into your self-managed super fund. When a contribution is made into a super fund, it has to be allocated to a member within 28 days of the contribution being made.
Contributions into super can be made in cash or in kind, or what is called in-specie contributions. Contributions into your super fund can be made a number of different ways.
In this video, we'll explore the most common ways to make contributions into an SMSF.
Employers must pay their employees the Superannuation Guarantee Contribution, or SGC, at the rate of 9% of their salary and bonuses. This is the law according to the Superannuation Guarantee Administration Act 1992. An employer making an SGC contribution for an employee gets a tax deduction for this payment. It forms part of the salary of the employee.
Often, SMSF members operate their own businesses and pay themselves the SGC as part of their overall salary package.
When a contribution is made into any super fund and a tax deduction is claimed by the party making the payment, this is called a concessional contribution, what was previously referred to, Aaron, as a deductible contribution. The super fund that gets this contribution must pay tax at 15% contributions tax on this type of contribution.
In addition to the SG contribution, you may wish to contribute more into super and be entitled to a tax deduction for it. But there are limits for the amounts of these contributions in which you receive concessional tax treatment. These limits are called contribution caps.
Currently, there are age-based contributions caps for anyone. These apply for those under age 50 and those over age 50. From 1 July 2012, there will be changes to the limits that you can make into your super. Further information about these contribution limits can be found on the Academy website.
Self-employed people and those working for an employer can pay super contributions up to their cap. An employee does this by arranging to salary sacrifice with their employer. The employee has an amount paid to super as opposed to going in their pocket as wages. With super fund tax at 15%, it is likely that this tax rate will be lower than your marginal tax rate.
Salary sacrifice arrangements have to be made at the start of each financial year with your employer, Aaron.
You can also make another type of contribution into super in addition to your concessional contributions. You can pay into your super fund your post-tax savings. These contributions are called non-concessional contributions, or previously were referred to as undeducted contributions.
You don't get a tax deduction for these. There is no tax paid when these contributions are made into the fund.
There are also caps for non-concessional contributions. A maximum of $150,000 in one financial year is permitted.
When you are under age 65 at 1 July any financial year, you can, if you wish, pay up to 3 years or $450,000 as a non-concessional contribution in 1 year. For example, if you did this on 1 July 2010, you cannot make another contribution of this type until 30 June 2013, 3 years later.
That's right, Ian. Contributions of both types, concessional or non-concessional, don't have to be in cash. You can pay them in kind or what is referred to as an in-specie contribution.
You should make sure that your SMSF trust deed allows for in-specie contributions before you make these into the fund. You can update your fund's trust deed to allow for this.
There is a general prohibition on acquiring assets from a member or related party. However, there are limited exceptions that can be used for in-specie contributions. Shares on any approved stock exchange such as the ASX, cash, business property and managed funds.
Before any contributions are made into your SMSF, you need to make sure that the trustees have your tax file number or TFN.
Without your TFN, the tax deduction the employer or the salary sacrificing employee would get would not be available. Without a TFN, the trustees might not even be able to accept the contribution.
More importantly, heavy tax penalties can apply without a member's TFN.
That's right. You don't have to be working though, Ian, to make contributions into super. You can still make contributions into super and get a tax deduction after you have retired.
Under certain conditions, you can continue to make contributions up to age 75. When retired, you may get income from other sources apart from your super savings. Up to the cap, you can pay contributions into your SMSF and potentially claim a deduction.
You can keep paying super contributions up to the age of 65 and actually not be required to work. After age 65 though, you must pass the work test to be able to make contributions into super.
The work test is working for more than 40 hours in any 30-day period whilst gainfully employed during the financial year in which you make the contribution into super.
And after age 65, you are restricted to making $150,000 only in non-concessional contributions in each financial year. You can, in the same year, still pay concessional contributions into the fund up to your cap as well. Remember though that the work test must be passed for you to make either of these type of contributions.
As well as making contributions into your SMSF, you can also roll over any other superannuation balances that you may have in another location or location. There is no tax penalty transferring superannuation from one regulated fund to another.
There are other types of rollovers, including termination payments and small business capital gains tax concession amounts, but the way these are made and received by your super fund are quite complex to say the least.
This video in no way covers all of the issues relating to superannuation contributions. Like the majority of issues in super and the rules and regulations that surround them, they're very complex.
That's right, Ian, I'd agree. If you pay more into super than you are allowed to in any given financial year and you exceed the caps, you could actually end up paying as much as 93% tax. So you absolutely need to be careful.
Absolutely. Before considering the payment of any sort of contribution into your superannuation fund, you should seek expert advice from an SMSF specialist advisor.
Further information on this topic can be found on the Academy website. Thank you for taking the time to watch this video.